Recently, a red warning light has turned on for the South Korean economy. The exchange rate has exceeded 1,471 and remains above 1,451, creating a true emergency. Some are voicing concerns that the rate might go beyond 1,501 and even reach 1,601. Today, let's take a proper look at the Korean exchange rate. Let's get right into it. The current exchange rate is extremely high. By November 25th, the average annual exchange rate hit 1,417 won. How important is this number? It's 18.12, one higher than the average of 1,398.88 won in 1998, right after we received a bailout from the International Monetary Fund. On top of that, since the exchange rate is now often exceeding 1,501, people are even expressing their concerns out loud, so the exchange rate situation is extremely high right now. Additionally, the Bank of Korea has frozen interest rates for the fourth time in a row. Although they plan to lower rates, the exchange rate surged above 1,471, the highest in 7 months, preventing a cut. Lee Chak-ryu, the governor of the Bank of Korea, explained that the reason behind the high exchange rate is not the interest rate gap between Korea and the United States, but simply because overseas stock investments have increased. He said young people invest heavily overseas because they think it's cool, and added the high exchange rate is affected by these investments. Experts say the high exchange rate is mainly due to the interest rate gap between Korea and the United States and the rapid growth of M2 money supply, not young people's overseas stock investments. I think we need to talk about the money supply in more depth. Many experts are pointing out that a relatively large amount of Korean won has been released. Money in circulation has risen 22.2% over the past 3 years and 9 months. The government keeps printing and distributing money. Despite the end of the COVID-19 pandemic, the government continues expansionary fiscal policies and printing money, causing the Korean won to lose value. For example, the United States saw a 29% increase during this period. While the United States tightens its belt, Korea keeps printing money, causing the Korean won to lose value faster. You can see this just by looking at the statistics. From January 2022 to September 2025, it rose from 3,639.4598 to 4,447.9604 trillion won, a 22.2% increase over 3 years and 9 months. During the same period, the United States rose from 3,152.8 trillion won to about 3,265.2 trillion won, a 2.9% increase. On top of that, the Bank of Korea often mentions the sharp increase in overseas stock investments by businesses. It's hard to explain the current exchange rate situation with just this one factor. Between November 3rd and 21st, the Korean won fell 3.29% against the United States dollar, the biggest drop among the 9 major currencies compared. The Japanese yen fell 2.11% and the Taiwanese dollar dropped 1.87% during this period. It was even weaker than some Southeast Asian currencies. So, while increased overseas stock investments may have influenced things, larger factors are involved. Experts point to the increase in money supply and the interest rate gap between Korea and the United States. The rapid growth in money supply, along with the interest rate gap, are key factors driving up the exchange rate. Right now, Korea's base interest rate is 2.5%, while the United States' base interest rate is 4%. The interest rate difference between the two countries is now about 1.5 percentage points. As United States interest rates stay high longer, the market naturally favors the dollar for obvious reasons. United States dollars provide more interest income than Korean won. Additionally, global demand for safe assets boosts dollar demand, keeping the exchange rate under upward pressure. Until now, Korea has generally followed United States economic policies. When the United States raised interest rates, Korea would follow suit, and that's how things went. But this time, Korea didn't do that. Interest rate inversion has been happening repeatedly, and the problem is that this interest rate inversion is now lasting longer than at any other time in Korean history. Korea's and the United States' interest rates have occasionally been reversed in the past, but it was rare. This has happened just 4 times, 1999, 2005, 2018, and now. Previously, most periods of reversed interest rates lasted 21 to 25 months. It returned to normal in about 2 years, but now things are completely different. The interest rate inversion has lasted 41 months since 2022. The duration is too long, and the pressure from the market taking the lead is also extremely high. The extent of the inversion itself has also widened significantly compared to the past. In 1999, 1.5 percentage points was the maximum, and now it's at that level again. That's just because the United States recently lowered interest rates slightly, barely narrowing the gap. The prolonged, significant interest rate reversal is disrupting the Korean economy and driving the ongoing exchange rate increase. But can the Bank of Korea raise interest rates to address this? Realistically, that's hard since household debt in Korea is too high. Many households have debt, so when interest rates rise, their interest burden quickly explodes. Because many rates are variable, the shock will be even greater. There's also a possibility that many people won't be able to cope with the sudden surge in interest rates, leading to instability throughout the entire financial system. This is why the Bank of Korea is very cautious about raising rates. Korea's household debt equals 89.5% of gross domestic product, reflecting the household debt to gross domestic product ratio. It's already at a dangerous level and ranks 6th highest among Organization for Economic Cooperation and Development countries. If we look at the countries with higher ratios, they are Switzerland at 125.3%, Australia at 112.7%, Canada at 99.1%, the Netherlands at 94%, and New Zealand at 90.1%. Korea is also closely following that trend. At this level, the interest burden on households can reach a point where it threatens the overall stability of the economy. Even a small rise in interest rates can seriously impact those in debt and may spread risk across the whole financial market. We're at such a sensitive point that it's hard to predict how fast or how much a collapse could happen. Due to this structure, the Bank of Korea can't raise rates, making the United States interest rate gap hard to address. If the gap stays for 10 years, pressure for the exchange rate to rise will persist. Korea's current issue stems from structural weaknesses combined with external factors, making exchange rate fluctuations an even greater burden. If there's any consolation, it's that many experts predict the United States will induce a weaker dollar starting next year. The United States will devalue the dollar for its own benefit. Kim Kang-seok, head of the Economic Research Office at the Korea Institute of Economic and Industrial Research, said the exchange rate will likely drop gradually to around 1,450 once. On top of that, the increase in overseas investment by companies is also contributing to the rise in the exchange rate. The United States government is urging major allied companies, including those from Korea, to make large investments in United States domestic production. By late September, companies' foreign currency deposits reached $92.26 billion, or about 135.62 trillion won. But that's $3.11 billion more than last year's $88.75 billion. For companies, they need to hold on to dollars for investments in the United States, and investing in United States assets is more stable and profitable. They're not exchanging currency, so the likelihood of funds in Korea being reconverted to won and returning is fading. If the high exchange rate persists, travel and study abroad costs will rise. Import prices will rise, increasing the risk of higher raw material and consumer prices. Rising prices are already visible everywhere. Those of you who drive probably already know gas prices have become incredibly expensive. Recently, international oil prices have dropped, but gas prices are still high. That's because of the high exchange rate. And recently, the prices of snacks and bread have also gone up one after another. The prices were raised due to the rising cost of importing raw materials and overall inflation. Australian beef import prices are up 10% from last year. The Korean economy now faces a unique situation. The exchange rate is rising despite the ongoing economic slowdown, not because the economy is recovering and money is circulating. This combination is putting pressure on the entire economy, and it's spreading a structure that shocks every area, from household finances to corporate management. First of all, consumption is rapidly freezing up. As prices rise, people are closing their wallets except for essential spending, and the burden of living expenses continues to grow as the high exchange rate drives up import prices. If gas and food prices continue to rise little by little, people will naturally cut back on their spending. When consumption decreases, company sales also drop, and the overall vitality of the economy quickly cools down. On top of that, import prices continue to rise. Korea imports most of its energy, grains, and raw materials. When crude oil, liquefied natural gas, grains, minerals prices, and the exchange rate rise, domestic manufacturers must absorb all increased production costs. Manufacturing companies see their profitability decline due to skyrocketing raw material costs and rising labor expenses, and eventually they end up raising product prices. This starts a vicious cycle where the prices consumers feel rise even faster. The problem is that business costs are increasing across the board. Logistics, raw material, and imported part costs are all increasing, forcing many small and medium businesses to rely on debt for procurement. If interest rates go up on top of this, the burden of interest payments will increase even more, and it's highly likely that we'll see a polarization between companies that can survive and those that collapse. As the economy cools down like this, if only prices keep rising, the risk of classic stagflation increases. When the economy is sluggish, but prices and even the exchange rate are rising, it's a sign that if the economy is shaken, it will take much longer to recover. This is Korea's current main problem. The exchange rate isn't rising due to economic growth or strong company performance boosting demand. Overlapping external shocks and internal vulnerabilities are causing both exchange rates and prices to surge, creating even more serious pressure. If ordinary households cut back on spending due to living expenses, and companies reduce investment and hiring because of rising costs, the economy will quickly lose its balance. The high exchange rate is more than a currency issue. It's seen as a double pressure weakening the Korean economy. I sincerely hope that the outcome will be a structure where everyone benefits. What do you think about the current high exchange rate? Please let us know your thoughts in the comments. That's all for this video. Thank you.